Hey, welcome back, dividend investors. Today I would love to talk a little bit more about Starbucks. Some of you have reached out to me in the recent weeks asking whether now is a good time to start investing in Starbucks. And I understand why, because the company was just at the start of the year still trading at $117 and it dropped all the way till $92.50 right now. Now, I understand that this makes you curious because Starbucks is an iconic company. It's a company that many of you know. We use their products probably on a weekly or monthly basis. We also know that this brand gives you something specific. You know, walking with your Starbucks hand through the streets is kind of iconic, and you see many celebrities actually doing this. So yeah, in my opinion, it's really a great company, iconic company. So there's one thing that always annoys me when I'm looking at Starbucks, and those are their share repurchases, their share buybacks. Because so far their buybacks have even left currently to a negative shareholder equity. And this always leaves me puzzled because, for instance, if you would now calculate the debt to equity ratio, it makes totally no sense because dividing a positive number by a negative number gives you really awkward numbers. So for me, it has always been a question like, what does this mean for a company like Starbucks? Does it mean that it is just like almost a default or something like that? Is there a risk associated to it that if shit hits the fan, that it would really leave us in trouble? So this is really the thought that I've often got in my mind. So what I will be doing in this video is looking a little bit further into dividends versus buybacks, but also does it matter that there's negative equity? I had to learn this a little bit myself, and this is what I really would like to share with you today. And after that, I will also give you a little bit more of the analysis of Starbucks with my fair value at the end of this video. So if we look at buybacks and the impact on the balance sheet of that with negative equity, this is not something unique. However, what we can see is that this is mainly happening in the United States. 71% of the companies with negative equity come from the United States. It's clear to me that especially in the United States, there's a strong buyback policy. Of course, there are also more stocks generally in the United States, so we need to take this also with a grain of salt. But only the UK scores a second place at a far distance already from the United States when it comes to this. But you know what is interesting based on this research that I found, and I will share the link in the description of this video, is that early results indicate executing a buyback while having negative book equity does not pose a substantial threat to the company's standing. So this is already quite, relieving me a little bit. However, it does not discredit the amount of risk companies with negative equity face. So it still means effectively do your own research. Also, based on the last 10 years behavior, there are still too few examples of sustained use to determine with certainty what implications they have for companies' long-term prospects. So we can still not say anything there. Previous research has shown that while companies with weak financials perform at similar levels to their peers in a bull market, long-term companies with strong financials rebound much faster after a recession. Well, I think we have seen this as well last year during the pandemic. We could see that well-capitalized companies like Microsoft really rebounded fast. So taking this into consideration, I think it's first good to start talking a little bit about share buybacks versus dividends. And what I've done is I actually put them beside each other. And it should come as no surprise that in general, buybacks are really effective when shares are undervalued, but also can be really ineffective when shares are overvalued. What I like about buybacks is that effectively more profit stays with the shareholder, so effectively increasing my stake in the entire company. At the same time, there are also tax advantages when we look at buybacks. 1, tax savings by the company. 2, tax savings by the investor, so me, but this only and mainly applies when the capital gains tax is lower than the dividend withholding tax, and this is actually the case in several countries. What I don't like about buybacks is really when they're overvalued and buying back shares, but also sometimes it's just a poor signal because effectively the company or the management is having their bonus, for instance, attached to the earnings per share. So the manager really benefits from this, but maybe they should better spend this money on innovation, R&D. So these are really some things that you really need to consider when thinking about buybacks. Last but not least, specifically if it's debt-fueled buyback, it might really deteriorate the balance sheet and therefore, as we saw earlier, give the company just less flexibility on a rebound. Having said that, if we look then at dividend investing, it's not all rosy here, although I'm of course the European dividend growth investor from that point of view. But what I like about it is that I as an investor get to decide what I can do with the money. I trust myself more than most of management even from the companies that I'm invested in. At the same time, stable and growing dividends are really a sign of confidence, that management also gets pressure to continue to focus on their cash flow. So I believe really that the incentives are better better aligned with me from a long-term investing point of view together with management. What I also know is that I get the share of profits now. We will, for instance, not know what will happen to a company like Starbucks in the future. They might as well get really poor results, and then, those returns are not there for us. And I could decide as a shareholder to actually use my dividends and reinvest them elsewhere. So this is what for me really is a positive for dividend investment. But of course, it's less tax efficient because, dividends are taxed twice. Firstly on the earnings, secondly by myself. And specifically in Europe, it's even harder with the high dividend tax rates that we have. At the same time, what I've seen several times, that if a company decides to cut their dividend, then usually a floor falls below the share price. And in that case, you have really like a double-edged sword, because one, you lose passive income, dividend income, and second, you can expect a lot of drop in share price as well. So you're double screwed effectively. And last but not least, of course, also here companies can really leverage up to just continue to satisfy shareholders. So in my opinion, and it shouldn't come as a surprise, dividends are in my opinion one of the best ways to reward shareholders sustainably. But of course, provided that the business is growing in a healthy way. So now that we have a clear picture again between buybacks and dividends, let's have a look a little bit at the performance of Starbucks. So what we can see here is that Starbucks since 2017 has at almost more than doubled the price. Of course, lately it went down a little bit. So let's say it has like an 80-90% return since then. What we can really quickly see here is with the cash allocation that, in 2015, 2016, the free cash flow was nicely covering both the dividends and the share repurchases. But this changed in 2018 and 2019. What is important to know is that the free cash flow was extremely high in 2018, and this was because of the royalty fee that Nestlé paid to Starbucks to be able to brand Starbucks and to sell it in supermarkets. It was a one-off. From an earnings point of view, it is like royalties over the next 40 years, but the cash came in that year. That's why we see it so high. But what we can also see is that the company has been really aggressively buying back shares. In 2018, 7 billion, and in 2019, 10 billion. And what we need to see here is that they did this at a price, around the $70-$75. So if you look at today, you could say like, hey, that was cheaper than where it is now, so it was probably good. But if you look at it from multiple point of view, I know that these multiples were the multiple of around 25 and 30 PE. Generally, I find that on the high end, so the company would really need to be a fast grower then to justify this. Also there, I believe this is not the case. I believe really they've been paying a lot for these buybacks. And what we can see here also, because of these large investments, and specifically in 2019 with this 10 billion, it went into a negative equity ever since then. So for me, it's really hard now to analyze the health of the balance sheet. And this is what I would like to share you now a little bit, like what is actually the impact of this? Because the debt went up, we can see that here, debt was around 4 billion in 2017, and now it is around 14-15 billion. So that's a lot of debt. It's like 10 billion more due to those buybacks. So with that, also the interest expense went up. So one of the questions that I have is like, okay, so what if inflation kicks in? Will this really hurt the company? And here's where I need to give some credit to management, because their annual report reads really nice and they are really transparent about this. So what they are saying here, when you go to their risk section in one of the latest annual reports from 2021, they're talking about the impact of an increase in the underlying rate based on the fair value of their long-term debt. And what they are saying is that 1.2 billion increase on long-term debt is expected when there is a 1% increase. And this has to do with derivatives and financial instruments that they are using. So it does have an impact on the long-term debt as a whole. So with this number, we can actually do some scenario analysis, and I've been doing this. So if we look at the impact of the interest rates increases here, we can actually make some calculations. So what I've been doing, I've taken the 2020 numbers and the 2021 numbers and the 12 trailing month numbers, and I've put them in here really to recalculate the EPS as an example. So what we can see is the interest expense went from 437 to 470, and with a trailing 12 month of 465. So what I've done here, I've got three scenarios. What is the impact of 0.5% increase in interest rate? What is the impact of a full percent? And what's the impact of 2%? So what you need to know is that the effective interest rate at the moment is 1.96%. 12%. How do you calculate this? You divide the interest expense by the total debt. And to calculate the total debt, you need to look at the short-term debt plus the long-term debt. And in the case of Starbucks, this also means their capital leases. So that's approximately 24 billion. So if you divide it by itself, we're talking about 2% interest rate. So a 0.5% increase would be like 2.5%, 1%, 3%, and then 4%. So if we take this back then, what we can see here is that the income before taxes here was 5,611. So if we go back then and we assume the operating income is stable, we can start calculating actually what the new interest expense would be. And remember, what we also need to take into account is the increase of long-term debt. 1% increase is 1.2 billion. So we're talking about 608 million for the first scenario, 1.2 billion for the second, and 2.4 billion for the third scenario, which means also that the debt numbers are rising. So with that, we can calculate the interest expense for instance, this scenario. So what you can then simply do is, multiply the effective interest rate with the new debt figure, and you see that we're talking here about the 600 million interest expense. If we do that for a 1% or 2% increase, you see that it goes to 739 and a billion. Now, a billion is twice as much, so it sounds really like a lot and probably really impactful, right? Well, here's where some magic of tax comes in as well, because the average tax rate in 2021 was 21.7%. And this can be calculated simply by taking the income tax expense divided by the income before taxes. So if we use this effective tax rate, we can really start to calculate what the net income numbers are. So in the case of a 0.5% increase, what we can do here, okay, so we take the operating income minus the interest income. We keep the other income expense for this scenario analysis similar. We then get a number here of 5.5 billion income before taxes times the tax rate. And what we can see is that we start to pay less tax as well, because then the net income is 4.288 billion. And if we then look at the difference here, we're talking about 105 million in difference between the normal scenario as we have it today. But if we then look at, for instance, the income before taxes, we are actually talking about more. We're talking here about 135 million. So what we can learn here is that just, what they always say, debt is more tax efficient and you've got a tax benefit here. That's why the impact is not so large as, for instance, the difference in general between the income and the net income. Having said that, if we then look at it from earnings per share, assuming that the company is not buying back any further shares, so what you can see then is that there is a 2.5% impact on the earnings per share for the scenario of a 0.5% increase in the effective interest rate. Now, if we do the same here for the 1% and 2%, you can see that the 1% scenario is 5% impacting on the earnings per share and 2% is 10% impacting on the earnings per share. And this is where it becomes much more, as you can see, and much more impactful. Because as an example, if we take the current multiple, the current multiple of 24.75 at the current share price of $92, and we would apply that multiple to the future EPS based on the development of the effective interest rate, you would see that the multiple would be increasing. But if we take this multiple just as a flat number, you would see that effectively on a 2% interest increase, the company should be trading at $83 versus 92. So that's like a 12 to 13% decrease here. And this is really interesting, don't you think? Because I think that this is a really good example of why stock prices typically go down when the Fed is threatening with interest rate increases. Because this is a real life example of the impact to us as shareholders. So now that we know this, what to do with this debt to equity ratio, because there's negative equity. So in that case, I think we need to start looking at other balance sheet metrics. And one of the first metrics that I would suggest looking at is actually the interest coverage ratio. So what is this? It's effectively the earnings before interest and taxes divided by the interest expense. And generally we can say is that if there is a multiple of more than 1.5, that the company can deal with its obligations. But we want to see more, of course. And here it's really looking good at the moment for Starbucks with a multiple of 13. But there's a catch there. If indeed the interest rates would grow by 2% to 4% effective tax rate for Starbucks, we would be talking about a big reduction in interest coverage rate. So this is what we need to take into consideration, and it will just make the value proposition for Starbucks much harder. At the same time, there are two other ratios. It's the current ratios, which are all the current assets divided by the current liabilities. Here we typically say like, if it's more than 1, the company should be in a good position. What we can see here is that based on trailing 12 months, the company went below. So this is for me like an orange/red flag, because we would really like to see this above 1. The same applies to the quick ratio. So here it's more about how quick can you pay everything off based on your liquid assets. So take it to your home situation. It's not easy to sell your house, right, as an asset, but you can take money from your savings account and sell your portfolio from the stock market to pay for everything you need to pay for the current liabilities for the people knocking at your door. You don't want to sell your house, which is more embedded in the current ratio. So here as well, we would like to see this more than one. And here, again, for me, it's orange flag to even a red flag. And what I have seen is that it's mainly because of the reduction of their current cash on the balance sheet. So in my opinion, going forward, they need to restore a little bit of this cash position again. Once again, I'm not too worried here because the interest coverage rate is really high. But you know, there's a reason why this company has not the strongest balance sheet. And that's really my conclusion here. Their balance sheet has been definitely deteriorated over the years because of the share repurchases. And I honestly believe they went a bit too far with all this debt. But hey, this is their shareholder policy, disclosure, right? I don't own any shares in StarBUX. So what I would like to see with such a company is at least a margin of safety of, let's say, 15 to 20%, even with such a powerful brand, before I would like to invest in it. So then the question is, how much is this company actually worth? So the company has been growing their dividends from 2012, just after initiating the dividend, I believe in 2010, from 34 cents to 1.96. Of course, this is really, really huge dividend growth. And we can see that here, a 5-year dividend growth, compounded growth rate of 19% effectively. At the same time, their shares went down from 1.5 billion to 1.2 billion effectively. Actually, it was a bit disappointing for me. It's like 25 to, 30%. I would have liked to see more, but that's what it is when you buy back shares at really high level share prices, right? What we can also see here, just in the key statistics, is that it's really around valuation here, why it gives up red. So price to earnings high, forward PE are high, but also balance sheet related. And this is what I like so much about my own dashboard, because it effectively touches on the 3 elements: their profitability via the income statement, their balance sheet strength, and their cash flow. So here it's clearly, when I see this, balance sheet is an issue, valuation is an issue, and the dividend yield could be a bit higher. That's also often correlated to the valuation, of course. So taking this into consideration, and when we're looking at the free cash flow numbers, over the last 5 years, it had approximately a free cash flow on average of 4.1 billion. So this is what I want to calculate with. So if we look then at the fair value here, 4.1 billion, I believe that the company should be able to grow their free cash flow going forward around 8% in the first 5 years and then 5% thereafter at a discount rate of 10%, because that's the average return of the stock market, but at a terminal multiple of 15. And now people might say here, this is on the low end, but remember, I want to discount a little bit for the weakness of their balance sheet here. A probability, because it is a bit harder for me to assess this company from that point of view, of 60% would give me a fair value of $67.72. More optimistic 10% growth rate and then 6% growth rate at a terminal multiple of 18, which is currently not trading at, would give me at a 20% also probability $84, slightly lower than where the company is trading right now. If we take a bearish scenario of 5% and 2% and a terminal multiple of 12, we would be talking about $50. So having said that, my fair value overall is around $67, which makes, in my opinion, the company overvalued by about 27%. Now, I mentioned already I would like to see a margin of safety on top of this. So let's say that I would be interested around the low 60s or the high 50s to, for the first time, initiate a position, knowing that I was already a little bit conservative in the free cash flow number that I took and the terminal multiples. So hey, that's it from my side. These are my thoughts about StarBUX. I find this always a really difficult company to analyze. That's why I really wanted to do my best effort in understanding the impact of the interest rates, because I see that there's a risk in general to the stock market, and what it would do to StarBUX for a company with so much debt gives me a better insight in making a judgment about the balance sheet. So hey guys, I hope you enjoyed this. If you want to see more of me, check the video on the left to see one of my latest stock analysis, and check the video on the right how you can analyze the fair value of a company yourself. Have a great week ahead.